Hey, welcome back everyone. It is time for another red hot covered call video. Hey, look, today we are going to talk about how I find my best stocks for trading covered calls. I'll tell you what, it's been a process over the past 3 years. I've fine-tuned my game where I can identify a great stock to use for covered call writing. Now, that's one of the biggest questions I get in my inbox all the time. Hey, John, how do you find a great covered call stock? Now, many people have many different opinions on this. And of course, we have to talk about the golden rules of covered call writing, but I'm not going to bore you with that today. Today, I'm going to show you how I pick a great stock, what I'm looking for. I'm also going to share with you the number one thing you shouldn't do. You absolutely want to stick around because that is the one that always bites us. So stick around for that. I know you're probably going to agree. Now look, let's go ahead and get to this. If you've never been to my channel, it's right there. Just subscribe to it. It's free. I don't charge you nothing. And look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now what we're doing is this, we're adding to our totals, man. I'll tell you what, my goal of $55,000, it's going to be tough to get there. It really is going to be tough to get there because over the past 3 years, I've found that my trading in December tails off. And I'll tell you, that has to do with taxes. It's a mental block for me because as we get into December and I see all the money I've made and the taxes I'm going to have to pay, I always downshift it, right? And quite frankly, last year, I think I only traded $400 in covered call profits. And the year before, I only had $800 in covered call profits. Right now, I think the numbers pan out. I'm going to have to bring a $2,500 month in December. And I don't know if I'm going to be able to do it. But with that said, look at that percentage gain, cash on cash. Like I've always told you, we can use the covered call strategy to knock it down. This is my cash printing machine. And I'll tell you, making 20% a year, year over year, I'll tell you, man, I'll take that every single time. With that said, there's a lot of naysayers out there, man. I want to encourage you. Give me a second here. I want to encourage you. If you find that success in the stock market, don't listen to the naysayers. Don't listen to the haters. Look, it is a rare bird that someone will step up, learn the stock market in general, learn, put in the time, put in the work, get their experience, right? It's a very small percentage of the world that'll do this because most people will not touch the stock market for whatever reason. So if you're out there learning, you want to get better, you want to better your life, I'll tell you what, man, I am encouraging you. So when you see people out there talking negative about the cover call strategy, when in fact you're having success, man, do not read those comments. Do not read those blogs. I'm going to tell you what, the cover call strategy is successful. And for all you new options traders, it's a great way to get into the options game. All over YouTube, you get the fake gurus selling you how to buy in 3 trading patterns. Look, you have to understand options and the risks that go with it. The best way to do that is using a stock and then selling an option, giving somebody the right to take your shares. I ain't gonna say it's safe because there's risk in everything we do, but it's more conservative than you buying calls, buying puts, right? Because when we sell covered calls, we are on one side of the trade, and even if we don't know anything about buying call options, you can visualize in your head who bought your call option and the risk they have taken, right? They have a deadline, right? That trade better get to where they want to be or else they lose all of their premium, the premium you were paid. Okay, I just wanted to get that off my chest. I'll tell you, man, there are a lot of naysayers out there. They ain't gonna bring me down because look at these numbers. These are real straight talk numbers. And it encourages me that I can do this with success. And I'll tell you what, it's better than failing, right? Let me show you how I find a great cover call stock. So the free CTP Dashboard is available for you. It's available for anybody. Just go to ctpdashboard.com. You can click download your copy. It's there. It's free. Look, you don't pay nothing. Just check it out. What it does is this. It's uploaded with 100 of the best stocks trading now. Well, if we want to start our covered call research, we need to buy a great stock. Now, I'm not saying these are the end all be all stocks, but these are 100 that are perched right where they need to be to meet the golden rules of covered call writing. So with that said, I love using this list. I've set up the CTP Dashboard where you could search this based on stock price. You may only have a certain amount of money. So obviously you're not going to be able to use a stock that trades for $700 if you only have $5,000 in your account. But you can surely find stocks that trade for $20, $30. There's a lot of great stocks out there that are less expensive. You just have to find them, right? You just have to know where to find them. Well, the free CTP Dashboard has them right there. Now, with that said, what do we want to do? We have to have a process in place place. And that process is simple for me. I want to own great S&P type company. The reason for that is because if I'm stuck holding the stock, I at least could sit there and tell my wife, when everything is falling out of the sky, right? I could at least sit there and say, look, with the best information available to me, with the best companies on the planet, I invested our money. And with that said, we can move forward, right? You're not going to lose sleep if you buy one of the greatest companies on the planet. Again, there's risk in everything, right? We're holding Win at 200. We get news he did what he did, and all of a sudden now I'm holding a stock that's trading at 90. Things happen. But what I want to do is I want to start to limit that risk. So I want to make good decisions. This is why we want to make sure we have a process in place. Okay, so I'm going to try to use S&P type company. I also want to use stocks that have dividends, because if I'm stuck holding the stock, at least I'm collecting a dividend. I mean, I love holding Chevron for writing covered calls. Now, Chevron trades in a range from 125 to 115. And when the stock is moving higher towards 125, I write a covered call. And then as it peels back to 115, I won't have my shares taken away, but I'm able to collect dividends while I'm holding the stock. I feel like I'm making good decisions. I'm holding a great stock. They pay a great dividend. So we want to find those great stocks with dividends that usually pay about 3%. Now, most people will say they don't need a dividend, and that's fine. That's part of my process, and I've been successful with that, okay? So we're starting to paint that picture of what it's gonna take to make a good purchase decision. We need to make sure we're buying great companies. They pay a dividend, so if the stock falls and we're left holding the bag, we at least collect a dividend. I know it sucks, but that's real life. Next, we wanna avoid the risks. And like I've said many times, the risk for holding stocks is in and around the 30-day earnings period. That's where you're going to see the most volatile time for these stocks. Look, I did a video a couple weeks ago where we talked about Nike, and I tracked Nike's earnings reports. And when Nike was trading for like $60, this thing would move 10% either way. I mean, that's 6 points for Nike, one of the biggest companies on the planet. And this thing's moving in 10% swings. So earnings reports can be volatile. Another thing that's volatile is same store sales, because they come out monthly. And I'll tell you, if you've owned any of the casino stocks that are in China, like Wynn, Las Vegas Sands, China puts out its monthly Macau report. And that's where Wall Street will beat up stocks or rally them higher. Look, we want to avoid those kind of things. So we want to avoid earnings reports, and we want to try to avoid same store sale reports and any report that's going to affect the stock, like those China reports from Macau. So we minimize that volatility. Now look, that means you're going to own a stock and write covered calls for 2 months, and then you're going to own that stock, or maybe you sell it for that 30-day window for which there's an earnings report. Now, when I trade my basket of stocks, I don't sell those stocks during that period. Recently, I was asked that question: do I sell the stocks that I'm not trading at that moment? And I usually don't. Usually the reason I get rid of stocks would be maybe I have a loss, maybe I have another covered call play and I need some cash. If I'm going to hold a stock as a part of my monthly covered call strategy, I'm probably holding it through earnings, and then I'm going to continue writing covered calls after. Now, we talk about that picture, right? And I know this seems very simplistic, but this is the truth. A picture tells 1,000 stories. And looking at a stock's chart, even if you're not a chartist, I'll tell you what, it tells a story. And if you're looking at Microsoft right here, right now, you can see is in that nice upward trend. Now, does that mean it's going to go up all the time? Well, no. Look back here. Microsoft got kicked in the ribs there with most of the market. So you have to understand there's volatility in everything we do. But we want that feedback. We want to know what the stock's doing in typical markets. Now, we're in a market now, we're getting a lot of news from China and the president's tweeting and this, that, and the other. So you are getting some volatility, and you can see that right here with Microsoft. Now, Microsoft's one of, if not the biggest company on the planet. So when you get that kind of volatility in a stock like Microsoft, then you know the markets are somewhat volatile. So it's very important to understand that and have that a part of your process. Man, if you can't handle the volatilities of a stock moving in 20-point swings like Alibaba or Nvidia, then guess what? You shouldn't own them. You should find the great stocks, look at their charts, see the range they're in. Now, with that said, you want to know how their business is doing, right? And I'll use Whirlpool as an example. I don't have a Whirlpool chart up here, but let's talk about Whirlpool. Remember when the China trade wars started? Whirlpool was trading near 200 and things were kicking, man. They had all the check boxes checked. Now, I know this because I was trading Whirlpool for cover calls. What happens next is a disaster for Whirlpool. The news comes out, there's a China trade war, and everybody thought with less Chinese products in the US, Whirlpool was going to flourish, right? They were going to sell more product. Then we find out the real impact was going to be the higher price of goods for them to build their product. So Whirlpool falls from 180 down to 100, okay? So you have to know the business they're in. I'll tell you what, I'll give you a quick example. Remember when oil was trading at 100 and it fell, right? We had that oil crash, I think in 2015. Well, I was like many of you, I just could not believe oil stocks would fall, right? Even though the price of oil was falling, I just had so much faith in oil companies. Man, they were paying the high dividends. What could go wrong? Well, when we step back from that moment and the thing that they sell literally got cut by 75%, you had to expect that their stocks were going to fall some 75%, right? I never forget, man, I was owning Conoco. I had tons of Conoco at 87. Man, that thing got down into the 30s. Absolutely kicking me in the ribs and emotionally. That is something hard to deal with when you're so confident, but I didn't really connect the dots between the business they have, the product they sell, and what happens if things go bad. That's very important. So you have to know the business they're in. In the case of Microsoft, man, they're everywhere. So for the most part, a company like Microsoft is going to weather the storm. Now, with that said, let's talk about that support line. You could see this support line right here. Wall Street loves to sell them off to support and then rally them higher to resistance. You could see resistance is right there. So it's funny how this works. They rally it up to resistance, and when it doesn't break through resistance, they peel it off. They take a little bit of a break. It falls back. Well, when it falls to support, they buy it up. It rallies back to resistance. This happens all the time with great stocks. Look, I'm not going to say this is a rigged game, but isn't it funny how that works? One of the things I love to use is the Keltner channel. See the Keltner channel here? The Keltner channel is an indicator of a stock's trading range. And what we want to do is we want to buy our stocks. If I'm going to put new money into the market, I want to make sure I'm buying this stock, this great stock, at the lower band of the Keltner channel, because I feel at that point I'm getting value, right? I'm not buying it at the high. I'm not buying a stock like Alibaba at 210. I'm buying it at 160, right? I want to get that value for my money. So the idea is it's more likely to rally back to that resistance line or the top side of the Keltner channel. So again, we're painting this picture. It's all about painting a picture, because as we do our research, we're starting to learn more about the stock, what it does, how it performs. We're starting to own that research, right? We're not just buying a stock based on an email we got, a PDF file, or hell, even looking at the CTP dashboard and just buying it because it's green, green, green. We do our research. Now, I can go on and on and on about the things that we absolutely need to do when we make that covered call purchase. But really what I want to impress upon you is this. We're putting real hard-earned money into the market. And the market can go up and it can go down. And here's the deal. We have no control of that. The only thing we can do is try to minimize the volatility by doing these things. Now, you can Google what are the covered call golden rules. In fact, if you go back to my channel and search golden rules of covered call writing, I've done many videos on it. It's important to lower the risk. See, a lot of people use covered calls for retirement income. Could you imagine your parents, your grandma, grandpa in the stock market, right? They're in the stock market and they're buying risky plays. They haven't done their due diligence. They've been advised to buy riskier plays to make high premiums, which means more money in the short term. That is scary. We want to make sure we adhere to the golden rules of covered call writing. We do our research, and man, we are checking off all the boxes of what makes a great covered call. Now, I'll tell you this, man, it is easy to fall into temptation of buying that stock for which we've heard about. Maybe we got a tip, we're going to go for it. I get it. We're human. We're not some covered call guru sitting on top of a hill. We're human, right? We have emotions. So for us, sometimes the biggest hurdle is not acting on our emotions. And that's why having your checklist, right? Your checklist of what makes a good covered call will keep us in our lane, right? Now, before I let you go, I'm going to share with you the number one fail when it comes to buying that covered call stock and writing that covered call. And I'm going to use a stock that I just bought 3 weeks ago. So PG&E is having problems, right? I mean, they are in bankruptcy and they are absolutely getting kicked in the ribs. And their stock price has fallen down to about $9 to $10. Well, some news comes out. News comes out that they're dealing with their lawsuits. It looks like they're getting their act together. And I'm looking at that stock, man. That stock was trading up at 80. And I'm thinking once they come out of bankruptcy, for which they've done this before, man, this is a great opportunity to pick up some shares. I mean, a lot of people have done this with GE, right? You're buying GE at 8. You feel like it's going to be that $100 stock like it used to be. Well, same with PG&E. And in fact, you talk to a lot of people and that's what they'll tell you. Buy, because you know it's going to go back up. Well, we don't know it's going to go back up. Well, when it fell to about $10.80, I said to myself, this might be a great opportunity to pick up some shares, and maybe it does go to $20. This begins a series of failures for which I have now lost $1,300 on this trade. What happens next is this. As the stock's going higher, I'm holding the stock. I'm thinking I'm going to hold it till it gets to 20. I have no ideas of writing a covered call. But as it gets higher, I look at the premiums. So when I look at the PG&E premiums for a $12 strike, remember the stock's trading about $11. I see a $12 strike. They were paying $1.50 for a 30-day trade. When I factored in the stock appreciation and the covered call right, I was making a juicy 20% for 30 days. So here is ground zero for most covered call writing failures. It's being seduced by the huge premiums. And what I mean by that is this. Give me a little bit of runway here. We should always start our research from where we started this video. We find a great stock, we do the research, we look at the charts, and when we get to the end and we start looking at the options, right? If the options are higher, that's great. We know about the stock, we know what it does, its tendency, its charting. What happens is this, and I got seduced with PG&E. We see the fat premiums up front, and what we're going to do is buy a stock, write the covered call, and realize that 20 and 30% gain, and we can't believe it. Man, we're printing cash, right? How can this be true? Well, it is. Some of these stocks really do have 20 and 30% premiums for a 30-day trade. And that's like unbelievable, right? Most people can't even make 30% holding a stock for 10 years. That's the problem. When we get seduced into buying a stock based on the premiums they offer, the system breaks down. The process breaks down. Because what happens is this. If I buy the stock based on a 30% premium and I start to work my way back, see, I own the stock, I work my way back in my research, I never get back to where I need to be, right? Because I've already bought the stock. I've already written the covered call. So now the research is going to be lazy. I'm not going to get back to where I was. I'm going to accept everything for what it is and we move forward. Do you see the difference? If we notice that stock with the high premiums and we step back, we start our research, we look at the chart, we look at the dividends, we look at the earnings reports, we look at all these things first when we get to the finish line, buying that stock to then write that covered call. Do you see how we're more empowered? We have knowledge. We now can make a good decision. And hey, if you're going to go ahead and buy that stock and write that covered call, hey, at least you could say you did your research. When we buy the stock and write the juicy, fat, 20 and 30% covered calls, and then we go back, man, it just does not work out. Most of the time, you're going to fail. And that is what I'm going to impress upon you right here, right now. Do your research from buying the stock first, doing your research first, and get to the premiums at the end, versus buying a stock based on a fat premium that you see. Because in this case, with PG&E, what happened? I'm holding that stock, right? I have these ideas that it's going to go to 12. Man, it is going to be a payday of 20% in a 30-day period. Hell, I might even use this stock for multiple trips. Well, what happens? PG&E gets some news. This thing falls to $7. And now I'm left holding the bag. I buy that option back for 5 cents. Now I'm holding a stock for which I'm down some $1,300. The news is very bad. I didn't do much research on the news with PG&E. Well, here I am. I had to take an L. I had to sell the stock because I'm fearful now that this thing can go from $8 to to $0. Now, with that said, it's a great learning experience because I got seduced by the cheap stock price, the high premiums, and look where I'm at. Had I gone back and done my research on PG&E, man, I'm gonna tell you what, I wouldn't have touched PG&E because they have some serious issues. And I'll tell you what, they may not get resolved. I'm going to leave it right there. I really do hope that you'll do your research. You'll have some sort of process in place so we minimize our risk. We're always going to have risk, but let's try to minimize that by having a process in place, okay? You're going to see many YouTube videos out there just talking about the basics of covered call writing. And I get it, right? But the reality is we need to get a little deeper because we are spending real hard-earned money. And in today's market, I'm telling you what, you can easily buy a Whirlpool at $200 and within a month, you find yourself holding it at $90 like I did. Look, we want to try to avoid those moments. We want to make sure we do our research. Hey, look, I really do hope you like this video. I hope it upped your game. Look, I got many more coming and I want you to stick around. So be sure to subscribe to the channel. And hey, look, until next time, may all your covered calls be profitable.